Imagine a world where you can predict the future. A world where you can accurately foretell the performance of your investment portfolio. This is not some distant fantasy, but a reality made possible through the magic of portfolio optimization. Portfolio optimization is a technique that enables investors to balance risk and return in their portfolios by choosing the proportion of each asset. This might sound daunting, but don't worry. We're here to break down this complex concept into bite-sized pieces. Special thanks to Hersh Oberoi for providing insights and technical know-how for the creation of this video and content. The first topic on our list is modern portfolio theory, or MPT. This theory is a key tool that assists investors in maximizing their returns for a certain level of market risk. Think of it as a balancing act, where risk is on one side and returns the other. MPT assists you in finding the optimal equilibrium. But how does it work? Modern portfolio theory requires some mathematical calculations to determine the optimal mix of assets. It considers three main factors: the expected returns of the assets, their standard deviations, and the correlation between them. Each asset in the portfolio has a potential return, an expected gain or loss, which is calculated using historical data. Then comes the standard deviation, which is a measure of volatility, how much its returns can vary. A higher standard deviation means more risk, but potentially more return too. Lastly, MPT looks at the correlation between this measures how the returns of two assets move in relation to each other. If they move together, they are positively correlated. If one goes up while the other goes down, they are negatively correlated. A mixture of assets with different correlations can help reduce risk. By considering these three factors, expected returns, standard deviations, and correlation, MPT calculates the portfolio that offers the best possible return for a given level of risk. That's how it helps you find the perfect balance. Next, we have the capital asset pricing model, commonly known as CAPM. It's a model that describes the relationship between systematic risk and expected return for assets. In other words, it helps you understand how much return you should expect for the risk you're taking. Now, let's talk about beta. No, not the fish. In finance, beta is a measure of a stock's risk in relation to the market. A beta of 1 means the stock moves with the market. A beta greater than 1 means the stock is riskier than the market, while a beta less than 1 means it's less risky. Volatility, on the other hand, is a statistical measure of the dispersion of returns for a given security or market index. High volatility means the price of the asset can change dramatically over a short time period in either direction. Low volatility means that the price does not fluctuate dramatically, but changes at a steady pace over a period of time. Then we have the Sharpe ratio, named after Nobel laureate William F. Sharpe. It measures the performance of an investment compared to a risk-free asset after adjusting for its risk. It's a way to understand the return of an investment compared to its risk. Now onto some tools that can help with portfolio optimization. PyPortfolioOpt is a library in Python that implements portfolio optimization methods, including classical mean variance optimization techniques and Black-Litterman allocation. And lastly, we have SciPy, a Python library used for scientific and technical computing. It contains modules for optimization, linear algebra, integration, interpolation, and other tasks common in science and engineering. In summary, portfolio optimization is a powerful tool for investors. It helps balance risk and return using theories like MPT and CAPM, measures like beta, volatility, and the Sharpe ratio, and tools like PyPortfolioOpt and SciPy. So, next time you're pondering over your investment decisions, remember these concepts. They might just be the secret to unlocking your portfolio's potential. Because in the world of investing, knowledge truly is power.